meeting is being recorded.
What if I have more subscribers?
Afternoon, everyone. Just reminding everyone to mute.
Jesus, we get new pots. I'm like, Grace, we don't need new pots. But he's like, yes, man.
Karen, can you mute all for me, please, except for my mic? Thank you very much. All right, good evening, everyone, and welcome to our first event for 2022, our annual forecasting webinar under the theme Rebalancing for Economic Recovery. We're honored to host you and particularly happy to have with us our speakers, Stacy-Ann Tait and Damien King, and our very able moderator, Kalilah Reynolds. Before we introduce our moderator, I would like to introduce Dwayne Barrett, our Director of Public Relations, to share with us for just a few minutes. He promised me it won't take 5 minutes, just to give us a quick overview of the CFA Institute. Dwayne, over to you.
Thank you very much for that introduction, Carrie-Ann. Good afternoon, guys. Welcome again to another brilliant presentation by Carrie-Ann and her team from CFA Society Jamaica. I'm just going to give you a quick overview. What is CFA Institute? So CFA Institute actually is a global body. They lead the investment portfolio management profession. As you can see from the slide here, let me just get my magic pen out. They're actually trying to enforce global standards of ethics in the investment community. They are concerned about having a properly educated professional CFA charter holder, and they are going to champion professional excellence in the investment sector, which benefits the overall society. So these three key pointers of CFA is something that attracts CFA Institute, is something that should attract you because the world of investment management is increasingly becoming more sophisticated, and we need persons who are competent, who are capable, and who are ethical in their investment dealings with clients, global investors. We want CFA Institute to ensure that there's integrity and trust in the global capital markets. So CFA Institute is worldwide, and we are pleased to be the Jamaican home of this global network. As you can see, they are all over the world, over 184,000 charter holders. We want persons to become part of our society, and we think it's best that individuals who are interested in joining our society reflect the issues and the mantra of CFA Institute, the ethos and the mantra of CFA Institute. So the main thing is that we're trying to make you an investment professional. So let's just put on the word professional. What makes someone a professional? Let's just put it like that. And it's going to be several characteristics that we're looking for. A common body of knowledge that is widely accepted globally.
No, it's just a CFA thing.
There's somebody.
As I close, I come to you with Romans 5, verses 1 to 5.
Hold on, I'm just trying to see who I should mute. I'm getting the background now. Okay, I think we have got that solved. Great. So basically what we're looking for is a common body of knowledge that is widely accepted and shared globally. So this is going to be global standards. It's going to be based on certification. So we want to put you to the test. You know, doctors call themselves board tested. Tested persons who possess the knowledge before practicing. A strong code of ethics, that's very important in today's investment industry. We want to ensure that the knowledge that we possess is not only retained for ourselves, but shared, especially with the investing community. We're going to involve and invest in continuing professional development, and through Carrie-Ann and her team, that's what this webinar is. And we're going to get everyone registered with the society. So your favorite CFA society will be the CFA Society of Jamaica. As I said, CFA Institute, they have three main pillars: credentialing, where they're going to be looking at developing future professionals, ensuring that existing CFAs receive value by being part of this global network. I think a lot of persons don't understand and the value of being part of this global community, because there's always a free flow of information among CFA holders worldwide. And we're going to advocate for standards that protect investors, standards that will enhance the functioning of capital markets. The CFA Institute, they, under their credentialing mandate, they are looking at different programs. So they have different programs. The newest one will be the ESG, Environmental, Social, and Governance Certificate, Environmental, Social, and Governance, which is looking at other issues apart from the financials that should govern and investment decision-making, things that are important to the investor, not only the financial returns, but what other good that you want to effect through the world, to the world, through your investment choices. So that's a ESG certificate. This is the gold standard program for all investment portfolio managers. At the end of the day, they want you to be an expert in all things investment. And it's not just particular securities, whether to buy Apple or whether to buy Amazon stock, but all managing your portfolio. So they're taking a portfolio approach. They also lead CFA Institute with thought leadership, influencing investment research, capital markets development, and those are some of the things that they do. We have several prominent Jamaicans, as you can see here, who are members of our society and our CFA charter holders themselves. We want to grow the amount of CFA charter holders in Jamaica. And we invite you to look and learn a little bit more after this webinar about the CFA Society and CFA Institute in particular. These are all young people, but they're all looking for new persons to join. We celebrate with those persons who completed the 3 levels required to get the CFA charter. So congratulations, Gabrielle. She not only completed the 3 years, but she did the 4 years of experience. So there's an experience requirement that is required after completing the examination. I know Stephen is working on it. And so congratulations as well to him. So let me end by saying, you need to record our contact information down. You can email us. We want to have a bigger impact on the local investment industry through having webinars like this. We are sure that you will join us in our mission in ensuring that the capital markets in Jamaica are operating within true ethical standards and the investors' rights is sacrosanct. Thank you very much. Carrie-Ann, did I finish it in time?
Okay, so I think Karen had me muted there for a bit. If that was just some housekeeping matters, but thank you so much, Dwayne, and I think that will be quite useful, especially for those persons who it's their first time joining us. So now I would like to introduce to everyone our moderator for this evening. So Kalilah Reynolds is no stranger to the investment and finance community. We know her for her successful #1 rated business show, Taking Stock, and the financial education program, Money Mondays. Her company, Kalilah Reynolds Media's mission is to help Caribbean people create and maintain personal wealth and prosperous economies by making business and finance easy to understand. So Kalilah is a proud wife and mom to 3 beautiful children. Welcome, Kalilah, and over to you.
Thank you very much, Carrie-Ann. And before you, Dwayne as well. Dwayne is really good with that pointer, isn't he? Like my writing with that thing would have been all over the place. I couldn't even form words, but thank you again for that very warm introduction. And good evening to all our participants, everybody who is joining us this evening. Good evening to our panelists as well. And welcome again to the CFA's annual forecasting webinar. It's the CFA's first event of 2022. And I'm sure for many of you in attendance, this is not your first time here. It's not your first rodeo. So welcome back. And for everyone who is joining us for the very first time, even if it's and it is virtual this year, welcome to you. And we're very happy to be able to accommodate you. We're happy to have you here this evening. You saw the information from Dwayne. Make sure you take that down and contact the CFA. So many benefits to be had. Well, our theme this evening is rebalancing towards economic recovery. Now, as members of the CFA Society and potential members as well, you serve a very important and a very elite role in this recovery. You are the people who everyone else, all of us lay people, look towards for guidance, and hence the reason for this annual event. And this evening, we'll be having a keynote address by Executive Director of Capri, Dr. Damien King, followed by a presentation by VP of Investments at NCB Capital Markets, Stacy-Ann Tait. And you will get an opportunity to ask questions at the end of the event after both speakers have completed their presentation. Now, let me advise you as well, don't save all your questions for the very end and then try to bombard us with your questions. So if one of the speakers says something, you can type your question then and there or make your comment. I'll take a note of it and we'll come back to it at the end during the Q&A session. Now, you, and I can be guided here, Carrie-Ann or Dwayne, you may also, I would like it if you would like to ask your question in person. You may be able to turn on your microphone, and as long as I get the go ahead from the event coordinators, but I think that would be nice if you can turn on your microphone to ask your question in person rather than me having to read all the questions, or maybe even if you're comfortable and you look presentable and you're decent, you may even be able to turn on your cam to ask that question in person. But if not, then you can just leave your comment in the comment section in the chat and I will read that for you. Carrie-Ann, I see you pop up ahead. I see you popped up there. Do I have the go ahead for that? You just have to wait.
All right ahead, Kalilah, that is fine. Would love that level of engagement.
All right, wonderful. Yes, so if you look presentable and decent, you can ask your question on camera, turn on your cam when that time comes, or you can just ask it using the microphone alone, or, you know, type it in the chat, whichever your preference is. So without further ado, let me introduce our keynote presenter this evening, a gentleman who really needs no introduction, but I'll introduce him anyway. Dr. Damien King is the Executive Director of the Caribbean Policy Research Institute, CAPRI for short, and that is a public policy think tank. He's also a former lecturer in economics at the University of the West Indies. He's written, supervised, and published academic work and policy papers in the areas of sovereign debt, economic modeling, international trade, and financial inclusion, amongst other areas. Damien is the author and editor, along with David Tennant, of Debt and Development in Small Island Developing States, Palgrave, New York. He earned his BA from York University in Canada, an MSc from the University of the West Indies, Jamaica, and a PhD from New York University in the United States. He serves on corporate boards in the public and private sector and enjoys watching West Indies cricket though. And I'm quoting him directly here, given the performance of the team, that is hardly the appropriate verb, referring to West Indies cricket. Take it away, Dr. King.
Thank you very much, Kalilah, and thank you to the CFA for the honor of this invitation. The economy is at a difficult pathway at the moment. Is everybody seeing my screen? Just checking. Are you seeing the shared screen?
Yes, we are.
Okay. You know, as I was coming to my office this morning, I heard a Beatles song on the radio, and it reminded me that the Beatles were somewhat fans of Jamaican music, and you can pick up a little ska and reggae in some of their songs from in the 1960s. And as I listened to the Long and Winding Road, I realized it's a good way to talk about and to think about the path that the economy has taken over the last couple of years and possibly for the next couple of years. There's a verse in the Long and Winding Road that says, "The wild and windy night that the rain washed away has left a pool of tears crying for the day. Why leave me standing here? Let me know the way." That kind of captures how we all feel at the moment with all the uncertainty around us. I'm going to use that as my takeoff point to talk about three things. First is to get a feeling of where we are at the moment. So kind of looking back at last year to get a sense of where we are going to go from here. And then look at both the downside of what might happen as well as the upside, so that everybody can make their own judgment about where the economy is going to go from here. The starting point has to be an appreciation of the scale of the disaster that has hit the globe and the Jamaican economy. Now, we're accustomed to disasters, we're in the path of hurricanes. And if you do an analysis of the fiscal cost of all the disasters that has hit Jamaica over the last 40 years, and you compare that to the cost of COVID in just 2020 alone, you see that we're in a different order of magnitude. We've been struggling to cope with that for the last 2 years. If you look at the headline GDP figure and use the fourth quarter of 2019 as the last normal quarter of economic activity before we started feeling the impact of COVID, then you get an index of how the overall economy has performed, how much production we've been capable of. And you see the worst of it really was the second quarter of 2020, when our economy had declined by some 17% from where it started. That was sort of the trough as far as the overall economy is concerned. We have recovered since then, but even up to the last available figure, which is the third quarter of last year, you can see we still are at about 6 or 7% below where we were before COVID hit. So even though there's been some recovery, we still have a ways to go. We can track the same information by looking at the unemployment rate. Jamaica had gotten to a record low unemployment rate before the impact of the pandemic, down to low 7.2, 7.3%. By the time we were 3 or 4 months into the pandemic, in the measure taken in July 2020, the unemployment rate had gone up more than 5 percentage points. Since then, again, we have seen a gradual recovery of employment to the point where the just released figure from Statin just a few days ago told us that the unemployment rate is now back down to 7.1, the low sevens, where it was before the pandemic hit. That, of course, does not mean we have had full recovery. Employment is just people are working. It doesn't tell you about what the jobs are, what the quality of the jobs are, or even if they are jobs in terms of how we understand what a job is. It just means that people are in some income earning activity. So while it is good to see that bodies are not idle, this, because the economy has not yet recovered to where it was before the pandemic hit, what we are probably seeing here is people having found something to do to make ends meet, or some kind of job, but not as lucratively or gainfully employed as before. But it does indicate that some kind of recovery is on the way. Let us look at what has happened now to the all-important fiscal balance of the government. I start this data in 2012 as a reminder to everybody of where our fiscal management is coming from. Where 10 years ago, before 10 years ago, Jamaica consistently ran large fiscal deficits. And once we got into the 2 IMF programs, those large fiscal deficits almost disappeared to the point where our deficits were within the margin of error of measurement. But again, with the advent of the pandemic, then the government necessarily ended up having to spend more than its revenues justified. And so we see the opening again of large fiscal deficits, over 2% of GDP. And so the economy finds itself, looking at these three figures, we find ourselves at the turn of the year, as 2021 turns into 2022, with an economy that is not still at the point where we can use exaggerated words like collapse and decimated. Some recovery is on the way, but because it is halting, because it is incomplete, there is great uncertainty about what 2022 is going to look like. And that is what I'd like to sort through now. Let us first look at the challenges that the economy is going to face in 2022 and beyond. The first one is the public debt. Jamaica has had an impressive record in reducing its public debt from above 140% of GDP in 2013 down to less than 100% of GDP before the pandemic. This is a remarkable achievement. I cannot find any other country in the world in the post-war period that reduced its fiscal debt from as high as Jamaica had down to less than 100% of GDP without debt forgiveness, without write-off of the principal of debt. It is a truly ambitious goal, and we were on our way to sustainable debt levels. This has been thrown off track by the pandemic, and while our debt level was expected to reach 90% of GDP in 2020, we're going to end up at 110% of GDP by the time we get to the end of the current fiscal year. Debt is rising again. This is going to increase the cost of debt servicing and therefore siphon public funds away from more urgent and more necessary expenditure. Another problem which has reared its head is inflation. The Bank of Jamaica has an inflation target range of 4 to 6%. Coming on to the last part of last year, it breached that range in a significant way at the upper end for the first time, reaching above 8% a few months ago. And while it has moderated since then, it is still well above the target. For this reason, now inflation itself is a problem here, but it has occasioned the Bank of Jamaica in its monetary policy to raise its benchmark interest rate, its policy rate, which had been at only 0.5% for the last couple of years, it jumped up by 100 basis points to 1.5%, then by another 100 basis points to now 2.5%. So we've gotten 2 percentage points increase in the policy rate in a fairly short time. This, of course, is going to have consequences. Interest rates have been trending down in Jamaica for a long time. Since the interest rate that lenders and borrowers agree on is the sum of two components. It's the real cost of capital plus what the expected inflation rate is. Then now that we have higher inflation, the interest rate has to compensate for that. And we now have, with the Bank of Jamaica raising the policy rate, we're now going to have a higher real cost of capital. Both of those factors are going to be driving interest rates up in the economy over 2022, during 2022. This is necessarily going to have a dampening effect on the investment that we have been seeing recently, and therefore put a dampening effect on not just investment spending, but consumer spending. And that is going to put some brakes onto the economic expansion. Another concerning factor, of course, is the pandemic itself. Nobody really knows what is going to be the viral evolution of COVID-19. And a number of different scenarios can play out. Amongst them, and the most optimistic one, is that it ends up becoming like a seasonal flu. Some people get it, and life goes on. At a more concerning end is that we get these exposures to a cyclical Omicron type virus that overwhelms the population. And even if it does not lead to, and is unlikely to, lead to lockdowns, because most governments are leaving those behind, we are still going to get a reduction in productivity that comes from large sections of the labor force being unable to work for some periods of time. So both that outcome itself and the uncertainty that repeated cyclical waves of an Omicron type variant makes us think about is also going to have a dampening effect. So those are the biggest challenges that we face in 2022. At the same time, as we think about those problems, there are also reasons to be optimistic. Let us look at the upside. There are three reasons to expect a growth impetus. The first one we referred to before, which is that there is excess capacity in the economy to get back to the levels of production, producing the same things in the same quantities as we were doing 2 years ago. And that gradual recovery has its own impetus to continue moving towards back to 100%. But a second factor is that historically, recessions themselves have been a growth impetus, because one of the reasons why an economy gets stuck in a structural sense is that if somebody comes up with a new business idea, it has to bid resources away from their current deployment. Working capital is already loaned out. Even at 7% unemployment, all the best labor and all the best workers have jobs. Productive capacity has to be rented from, it's tempted away from its existing uses. So the difficulty of moving productive resources from its existing activity into a new idea is a constraint on an economy to grow. The great thing about recessions is it throws productive capacity idle. There are unemployed people and empty offices and working capital sitting idle. And so it makes it easy for an economy to shift into new activities. consistent with the historical record is that in 2021, we have seen record registrations of new businesses in Jamaica, according to the Companies Office of Jamaica. And this pattern is playing out all over the world. Same thing has happened in the United States. Same thing has happened in the UK. There's a third impetus though, and it is innovation. When regular activities and old habits become disrupted, people not only find alternative ways of doing what they were doing before, a significant percentage of the people and businesses find better ways of doing it. Zoom is an example. If the coronavirus infections were to disappear next week, and everybody could actually go back to what they were doing before, a significant majority of meetings would take place remotely. Because for some meetings, for some collaborations, we have found a better and easier way than getting in our cars and using up gas and getting into traffic and driving across town. And we see the same kind of innovation every time there's a disruption of any kind. So this third factor is a productivity gain that economies benefit from. And actually, there was evidence that the same thing happened during the Spanish flu of 100 years ago. That it was followed by a burst of innovation, which led to what was then called the Roaring Twenties. Those are three strong impetuses for economic growth. The debt has been Jamaica's probably biggest growth constraint up until 10 years ago. We mentioned that the debt has been coming down, and we are now concerned that the coronavirus has thrown that trajectory back upwards. But we have better fiscal governance now.
Dr. King, I think you're muted. Still muted. You're unmuted and then you're
I'm
good.
unmuting and okay, I didn't do it. It seems to be doing it on its own. Okay, sorry about that. Yes, so it is our fiscal responsibility framework that caused that impressive reduction in the debt. Even though we are concerned that the debt has started to go back up, that framework is still in place. And indeed, even at the higher level now of 110% of GDP, that debt is sustainable. That if we continue along our present trajectory, and this is clear from the Ministry of Finance's medium-term projections, the debt is on track to continue going down to a sustainable level behind the schedule established before, but still getting to that level. So not quite as big a problem. The debt dynamics, even at the high level that debt now is, are sustainable. And that's an example of a general point, which is that we have a stronger institutional framework for economic governance than we had 10 years ago, than we had when Jamaica got into its fiscal and monetary problems. In addition to the fiscal responsibility law, we have an independent central bank. The central bank is institutionally committed to inflation targeting. We have transparent fiscal management, where budgets are promulgated on time. Legislation has been passed to establish an independent fiscal council. We have reform of the boards of public bodies. And so what we see is the stronger institutional framework of fiscal and monetary governance is going to give us the ability to get back on track despite the setback of the coronavirus, that we can actually say it's going to be temporary. Evidence of that is that the central bank's net international reserves, which had been just above 3 billion leading into the pandemic, even 2 years into the pandemic, is now at the higher level of $4 billion US. These are all the reasons why the IMF recently issued a prediction 2 months ago that Jamaica's growth rate in 2022 could be as high as 8%. If we weigh the challenges, the concerns against the reasons why we think there is room for some optimism, then we can put those into a temporal framework, by which I mean that the concerns we have are more likely to manifest in the short term. The inflation problem, the interest rate problem, even the coronavirus. And the factors that give us reason for optimism are the ones that are going to show themselves up in the longer term. So we may still have our concerns about 2022, but beyond that, there is great reason for optimism. And I think we can reflect that with the lines of another Beatles song. This one was their reggae song, which everybody should know. Obla-dee, obla-da. Life goes on. La la, how the life goes on. Thank you.
Thank you very much, Dr. King. That was a very, very good presentation. You made some excellent points there, and I'm looking forward to coming back to the Q&A session later on in the program so that we can delve deeper into some of the issues that you raised. Now, before we continue with our program, I would like to ask our participants. I see 60 people in the room now, so yay for that. You have a nice hefty number. I'd like to ask you to take our poll. So we have a poll, and Carrie-Ann, you can advise how they can take the poll. The poll question is, oh, here it is, it just popped up. So the poll question is, well, there are two questions. Which participant type best describes you? So they want to know if you're a member, you're a guest, a member of other professional body, and they also want to know where you heard about this event. So just let people know, let us know where you heard about the event. Just take that poll really quickly. Let me fill it out myself. Guest for me. And where did I hear about it? Well, I saw it on Instagram. I was invited, but I also saw it on Instagram. So I'm going to take that poll myself and click submit. Let me ask everyone else to do so. It just takes a couple of seconds. All right, so hopefully you have done that already. And now I can introduce our next presenter. Stacy-Ann Tait is the Vice President of Investments at NCB Capital Markets. She spearheads the development of the company's business strategy for its regional proprietary investment portfolios while leading the trading and portfolio management teams. She has over 15 years experience in the financial services industry, and this includes experience in portfolio management, risk management, and corporate finance. Stacy-Ann holds a Bachelor of Science in Banking and Finance from the University of the West Indies and is a CFA charter holder. Welcome, Stacy-Ann.
Thank you very much, Kalilah. Good evening, ladies and gentlemen. To get us started, let me just share screen here. All right, please confirm that you are seeing my screen, please.
Yes, we can see it.
Awesome. All right, good evening again, ladies and gentlemen. It's really my privilege to be here this evening, and it will be hard to follow an act after Damien, but I'll try. Just to give you a little bit of walkthrough in terms of the flow of the presentation. So I'll be taking you through, and I will be touching on some macro themes that Damien would have touched on before, and where I do, I won't spend too much time on it because he covered it quite well, but I'll link those back. We'll now look at some housekeeping rules to investing, put those together, and then we're going to roll our sleeves up, and then we're going to rebalance our portfolios, right? Because we're rebalancing according to the recovery that we're expecting. So for 2022, there are three big themes that we think will impact the economic recovery and the financial markets recovery. And those three themes are continued evolution of COVID-19, elevated inflation, and rising interest rates. Now we're going to go into these themes. So the first theme is living with COVID, right? And this has to be the biggest theme of 2022. And it's the biggest because COVID is surging. There are concerns about new variants, there are concerns about new waves, and to Damien's point before, we just don't know when it will end. And it's so broad reaching that it has to be the most important theme because it affects so many different things. So what is the most likely outcome? Omicron, other waves, other variants, they're just going to be serving as a bump in the road to recovery, but it's not going to derail it. Now, a lot of adverse impact would have been felt to the economy or in the economy, and Damien would have touched on that. And there's some lessons learned from that, because what it tells us is that governments will be far more reticent about shutting the economies down, and they can't afford that anymore. And so border closures, that's going to be a thing of the past because we're heading to recovery. We have to live with COVID. So opening up travel, opening up tourism, opening up entertainment, all of that is going to go towards the road to recovery. Now, as we think about COVID-19, uncertainty prevails. Now, what we're saying to you is that the uncertainty, it's not going to disappear because we're not out of the woods as yet. But what we're thinking is that the uncertainty is actually going to be reduced, because if we're taking the lessons, we're learning them, what it means is that we look at the news of COVID a little different. So investors are going to have some negative investor sentiments towards COVID and its impact, but because they will now realize that it's going to serve as a bump in the road and not a complete derailment, what it means is that they'll get over it quicker, they'll process the news differently. And so the wild swings that we were seeing in asset prices and the wild levels of volatility, whilst we should expect some more, we don't expect them to be that large and last that long. Now, coming out of COVID, there are some positives, right? Businesses and households have been forced to look for ways to adjust to this new norm. In fact, we don't even know fully what this new norm is going to look like. But guess what? It's forcing businesses and households to think and expand their minds in doing things differently. And so digital transformation, innovation will continue to be key enablers that's going to add to the economic growth and profits of companies within the marketplace. Now let's examine our second theme. We touched on this before, elevated inflation levels. This is something that's affecting the globe. And why is that happening? Because there is pent-up increased demand for goods, the supply chain issues. We think about COVID and the impact on the labor force, whether that be taking away the laborers because they're getting sick and they can't come to work. It affects the labor shortage in different ways. So let's take this back a little down to our local setting. Inflation has been running hot for a while, will continue to. And unless the inflation drivers, the external shock, if they're not fixed, then we're continued to see this level of inflation going forward. And let's take it to a little bit offshore. When we think about the US or closest trading partner, they're suffering from the same thing, these high elevated levels of inflation. So as at December, their inflation rate was 7%. This is the highest that they've seen in 39 years. So it helps us to see that COVID, the biggest theme for 2022, is touching different countries in the same way. Let's have a look at and this is just a graph showing you where the inflation has gone and where it's expected to go. And that would have been touched on before. Let's look at the third theme. The third theme is rising interest rates. Now, it's a problem that a lot of places around the globe are suffering. Why? Because rising inflation is a problem. So the Bank of Jamaica, we know, would have hiked rates by 150 basis points. And it is anticipated that more interest rate hikes are gonna come from the Bank of Jamaica because the need to combat inflation, it's necessary. And Fitch actually has a projection of another 25 basis points increase that would take the BOJ's policy rate to about 2.75. Now, it is possible that the policy rate could actually go higher than this 2.75. It could go as high as 3%, because there are schools of thoughts that, look, the interest rate hike could be higher and maybe a total of 50 basis points over another 6 months. Now, let's again look at our nearest trading partner, the US. The Federal Reserve is actually set to increase interest rates sometime around March of this year. And the reason for that, again, combating inflation. And they're expected to increase interest rates from 0.25% to 0.75%. Now, again, word is on the street in terms of just the market participants and how they feel and assess things. Now, it is possible that rate hikes could be higher than this amount. And we see that volatility playing out in the US 10-year Treasury yield that has started to pretty much price in this interest rate hike that they're expecting. And so 10-year Treasury rates are very important because they affect bond prices for the emerging market portfolios. And so we tend to watch that very closely. So these, I would have to say, are the biggest themes that are going to affect the road to recovery and the financial markets. And of course, we just see a graph of the rising interest rates, just helping us to appreciate where we're coming from, right? We're coming from over 5%, we came down to the all-time low, and now we're heading back up. So let's put all these themes together and establish our housekeeping matters. And what are those housekeeping matters? The housekeeping matters are establishing principles for your investment decisions, right? So we want to look at 3 principles to the investment decision-making process. And those are establishing an investment philosophy. Now, this is super important. You need to be clear on what investment principles, guidelines, strategies inform the decisions that you make. What informs what you buy in your portfolio, what you sell in your portfolio? It has to be guided by something. Now, some of those guidelines could include your investment styles. What do you look for when you're investing? Do you look for value? And I know there's no one on this call who does not love a good discount, right? Whether it be clothes, whether it be food, whether it be shoes, whatever we're shopping for, we love a good discount. So when we talk about value style investment, that's what we're talking about. We want to buy investments with a discount. We look at growth investment. Are you focused on investing for growth purposes? We're talking about momentum. Are you investing because you want to pick up on a price? You look at environmental and social and governance factors. A nice way of just kind of lumping that all together. It kind of crosses over into the border of social or socially responsible investment. So you want to think about your style. You want to think about what drives your expectations. We're talking about the themes. What do you use to drive your expectations? Do you look at the fundamentals? Now, fundamentals of the macroeconomic framework, some of which Damien would have gone through, right? Or do you look for technicals? How the market statistics move, how the statistics show that there is a mispricing or that there's an opportunity. Very important here. You must establish your risk tolerance. What level of volatility can you take? Are you a conservative investor? Are you a high risk investor? And then time horizon is very important. So how long do you want to be invested for? Is it the short term? Is it the long term? Now, I just want to let you understand that tonight, what we're going to be talking about, especially in certain areas of the asset classes, we're going to be speaking more on the longer term side of the investment horizon. And it's important because remember, what we're doing is rebalancing for the recovery. Now, you need to stick to your investment philosophy in times of volatility. So when the road gets tough, you want to stick to it. Now, of course, you're going to make tweaks to the investment process, but your core fundamental principle, your philosophy should not change. Now, diversification, very important. My grandma always tell me, don't put all your eggs in one basket. Big theme for investment. You want to limit your exposure to any single asset or any single asset class or risk type. Now, the reason is performance in one area, great performance will help to offset performance that's not so good in another area. So what should your portfolio look like? You want to include different types of assets, bonds, shares, alternative investments, and cash. And then the last housekeeping investment principle that we're going to look at is utilizing the barbell strategy, right? And the barbell strategy or the barbell principle, it's really focused on investing in a mix of high risk and low risk assets and putting that together. Now, the benefit of that is that it creates a balance between risk and reward to kind of maximize the risk adjusted return. So as Damien said before, we don't know when COVID is going to end. Nobody knows. In fact, if we had a crystal ball, we would not be here, right? So because we don't know and there's a lot of uncertainty, what this principle does is that it allows us to strike a balance. It doesn't allow us to go to any one extreme. So you give up all risk and just sit in low risk, not yielding much. That's not what you want to do. We want to create that balance to take advantage of the volatility. Now, we've looked at the macroeconomic themes. We have looked at our investment principles. We're going to put those together now, and then we're going to use that to now figure out how are we going to rebalance the portfolio and position for the recovery. So let's start off with fixed income. Let's paint this picture. We are coming out of a low interest rate environment, right? And most portfolios would have been locked into fixed rate long tenured bonds with much lower yields. What's the impact of that? The value of those bonds will decline as the theme of rising interest rates play out. Now, rising inflation, what does it do for your fixed income portfolio? It reduces your purchasing power for that related income. So here are some things to consider as we position for the recovery. We want to pair short-term bonds with long-term bonds, and we want to range in a duration between ideally 3 to 7 years. Now, why especially 3 years? Because what you're trying to do now is to lend some shorter duration assets to the fixed income portfolio. And of course, you're getting to participate in the higher interest rate environment. 7 year, not a bad duration. And of course, you can tweak this according to your own portfolio. But 7 year, and what it allows you to do, remember, you are now locking in interest rates in a higher environment. Now, how do you do that too? You focus on variable rate structures. By focusing on variable rate structures, what you position your portfolio to do is that as interest rates go up, so does your earning, and you are just growing along with the rising interest rate environment. And then where you're now picking up fixed rate for a long time period, it is important that you price in your interest rate outlook. So we spoke about it before in the theme, and we said that interest rate is going to increase. How do you price that in to ensure that you are not giving up value and that your portfolio will not be hurt given the theme of rising interest rates? Now, you want to hold a good mixture of JMD and USD bonds. Why USD, you may ask? Because hard currency acts as a hedge for depreciation. And so in choosing these companies, you want to look at fundamentals and you want to look on the company outlook. Company outlook is really important. Why? Because we need to know, are the company's performance or is the company's performance leveling off? What is the outlook? Given the macro themes, what is it expected to do? Now that will help you to determine the credit risk and the quality of the credit that you're investing in. And you want to look at the long-term portfolio. So again, let's think about it. You have this portfolio of long-term bonds before, you're now going to capitalize on some higher interest rate bonds, but what happened to the existing portfolio? The theme is, so interest rates will go up, they will level off, and then at some point in time, they will come back down again. So again, it helps you to appreciate by now doing this strategy, how you position the portfolio to take advantage of the environment now, and then also seeing how the longer portion of the portfolio will perform. Last but not least, remain liquid. It is important to have some liquidity. Why? Because liquidity allows you to take advantage of opportunities in the market, especially with volatility. Now, by remaining liquid, by investing in money market instruments, repo, BOJ CDs, what it allows you to do is to quickly convert that liquidity into the opportunity without having to go and sell something in your portfolio to make a loss to go and invest in the opportunity. So it really helps. So that's how we're going to position the fixed income portfolio. Now let's move on to the equities side of things. Now in 2020, the Jamaica Stock Exchange combined index would have declined by about 22%. Now in 2021, it only grew by 2.2%. And that 2.2% was largely fueled by the movements on the junior market. Now, of course, the junior market is a much smaller subset of the combined index, so hence the 2.2 combined return. So it is telling us something. The market has not yet fully recovered. Therefore, if it has not fully yet recovered, these are some of the things that we need to anticipate. We need to anticipate a market rebound and wider economic recovery coming from higher vaccinations, relaxations of COVID measures, reopening of schools, employment, consumption, and new listings. So if you're anticipating that, what will you do? Let's roll up those sleeves. We're gonna look at buying undervalued equities. Earlier, I spoke about everybody loving a good discount. We're gonna look at buying undervalued equities, and we're gonna complement that with growth stocks. Now, why do I say complement that with growth stocks? In the theme of rising interest rates, we have to be careful with growth stocks because their valuations get heavily impacted adversely, right? That's one. And then with rising interest rates, the earnings of growth stocks, their future earnings, they become less attractive. And these growth stocks, they can't borrow, or these growth companies, some of them can't borrow at the cheaper rates anymore because the rates are increasing. But there's still a place for them. Again, remembering kind of like the barbell principle and the balancing act, right? There's still a place for growth stocks because you can choose sound growth stocks to complement your undervalued equities, your value equities. Now, with that said, what are we going to do? We're going to overweight the portfolio towards value stocks. So for the stock section of the portfolio, we're going to look more towards value stocks. Now, to do so, we're going to rely on strong fundamentals, market presence, sustainability of competitive edge. We spoke about coming from COVID and going into the new norm. What is that sustainable business edge and competitive edge that they have? And something important that we want to look at is the strong management team. Why is that important? Because in a period of volatility, uncertainty, you need to ensure that you are investing in companies with strong management team that has the flexibility, the agility, and the know-how to respond to the crisis and also to create opportunities out of those crises and to ensure that a stable company remains. So you're going to look at certain things such as digitization, e-commerce. What does that look like? And I mean, there are certain other sectors that I'd like to share with you that can benefit from the recovery that we have here. We're talking about tourism, right? Banking, manufacturing, distribution, real estate. We're looking at construction, e-commerce, transportation. These are some of the key segments that we're expecting to benefit from the road to recovery. And you would want to look for opportunities within the equities market here. Now, just to go back, none of us can perfectly time the market. We don't know when the market will bottom. One of the things that you can utilize while rebalancing your equity portfolio is to take an incremental approach, acquire or buy in increments, and that will help you to average down the cost. Now, we spoke about long-term investments before, and this is particularly very important. The equity investments, the longer it is, you find that the return is greater. And I'm going to give you this statistic to help you appreciate what it is that I'm saying. Now, in 2008, after the global financial crisis, the JSE main index actually declined by about 26%. Then in 2015, the market actually rebounded, and the market rebounded to actually 88% return in comparison to the 2008 level. Now, if you had invested in undervalued equities for that 7-year period, you would have been able to share in that strong return. Now, I'll take it a step further. If you actually remain invested from 2008 to 2019, just before this COVID crash of the market, then you could have shared in upwards return of over 500%, right? If you had invested in good value type companies back then. So it shows you that there is benefit to remaining invested in the long term, especially for equities. And don't get me wrong, guys, we always know that there is a place for some short-term investment, but the core of your portfolio and undervalued equities, this is something in the long term that we want to think about. And then or last asset class that we look at is alternative investments. Now, these investments offer higher risk-adjusted returns. And what we use them to do is to complement all the traditional type assets. So we use them to complement a portfolio of stocks, bonds, and cash to give us that boost to the portfolio. Now, locally, the need for this investment solution has been growing because persons are looking for diversification. They want higher returns, as well as we've been in a period where there've been significant spread compression or income compression. So what do we want to consider? We want to consider adding an investment property, real estate. No, not everybody. I certainly couldn't find the money to just use and to just go and buy a place just like that, right? But if we can't, and we're talking more like institutions. So if institutional investors want to add properties, that's a good thing. But retail investors can have a share in these higher returns too, because then retail investors could invest in a vehicle that focuses on real estate investment. And where is the opportunity in the real estate segment? We think the opportunity is in the commercial and industrial segments. So before we would have spoken about the demand and export growing, there's need for manufacturing space, there's need for warehousing. So we want to look for these pockets of opportunity within the real estate market. And there's also a place in the residential too, especially for the working class people who want housing. And we're typically focusing on housing, 1 bedroom, 2 bedrooms. There's a real demand there, and the demand for that significantly outstrips the supply. Now, private credit, private equity, this is investing in companies that are not listed. No, you can invest in this primarily through vehicles, and that is the best way, because these types of investments, they require a certain level of digging deep to ensure that the opportunity is rich and robust. And so investing in a vehicle, you can have access to professional money managers doing this for you and just collecting the higher check at the end of the day. And then there's structured products, right? Structured products, I would like to define them as derivatives. They oftentimes derive their value from another asset class, and they're able to provide you with higher returns because they come with that boost like an equity return. So we call them like equity kickers that gives you these higher returns. Now, this alternative investments is so important, and it's something that I want you to consider here, because through NCB Capital Markets Stratus Alternative Investment Funds, we have launched the Caribbean Mezzanine Fund, the Infrastructure Fund, the Tourism Response Impact Portfolio, and the Regional Opportunity Fund. Now, these funds, they provide investors with the ability to invest in non-traditional assets and to earn a pretty attractive risk-adjusted return. And we're talking about attractive risk-adjusted return. I should tell you, so like the Regional Opportunity Fund, the targeted IRR on that portfolio is 15%, which means that your money managers are selecting investment opportunities at NCB Capital Markets to be able to give you that 15% return, which is a pretty significant return, risk-adjusted return. Now, because this asset class is so important and the need for it is growing, NCB Capital Markets is committed to building out its alternative investments platform in 2022 to take advantage of the opportunities and to provide opportunities for the wider market and for the clients of NCB Capital Markets Limited. So let's walk through this. We looked at 3 broad macroeconomic themes. We looked at some principles that we must adhere to the investment process. We put those together. We looked at ways that we can rebalance our portfolio. Now, having done all of that, my question to you, how will you position for the recovery? Thank you.
Thank you very much, Stacy-Ann. Another excellent presentation. So we would have heard where Damien gave us more of a macroeconomic look, and then Stacy-Ann came in with the look at things that we can apply for our individual portfolios. And even so, you would have noticed the overlapping themes, right? Both of you had some of the same general themes going on, looking at living with COVID as being a major theme for 2022, inflation and high interest rates. And these are admittedly the top 3 things that we've all been talking about in all of 2021. So it's no surprise that that these are the themes for all of you. Well, let me take a look at the chat and see if we have any questions here yet. No, not yet. So don't all ask your questions at once. Remember, you can type in the chat, or if you want to ask your question in person, use the raise hand feature here in Zoom so that I can ask you to unmute your mic or put on your camera as well, so you can ask that question in person, and just let me know what your preference is. But I will be getting the ball rolling with some questions from myself, because I was typing frantically, taking notes for myself as I do whenever I attend these events. It's very, very important and relevant information. And so I'm going to start with a question for Dr. King, since you were the first presenter. And you mentioned at the end, towards the end of your presentation, that many of the concerns that we have are mostly short term. So looking at the inflation issue, looking at the interest rates issue. But you did mention in the presentation as well that debt is a major issue. Public debt is a major issue coming out of COVID. So we should have been at 90% of GDP by 2020, but we are actually ending up in 2022 around 120% of GDP. So that is a long-term issue. That is a long-term problem. How much of a problem do you anticipate that will be, and how difficult would it be for us to get back on track?
Well, I think you are right when you say the numbers look like it's a big setback, where we should have been at about 90%, possibly less than that, and we're going to end up at 110%. That's a 20 percentage point difference. That's a lot of debt. But 2 things to consider is that the cost of debt, the cost of public debt to Jamaica, is a lot less than it used to be when we suffered from negative debt dynamics. And the reason for that is that the reason why lenders have to be compensated for a high rate of interest, with a high rate of interest, is because they are uncertain of being repaid. So back when we had debt that was 130 and 140% of GDP, we had high cost debt. At the time when Jamaica was only the 3rd most indebted country in the world, we had the highest levels of debt service in the world as a share of GDP. There was one particular year when literally half of every dollar of tax revenue went to servicing debt. Now, our cost of debt is much lower because our debt is sustainable. Everybody pretty well knows that we're going to get repaid. And that, along with our better fiscal management overall, tells us that even though we have lost 20 percentage points, we're going to end up back on a sustainable debt trajectory that is going to be going down. So it's something to pay attention to. It is something to be managed, but it is not a huge concern.
Great point. Thank you for that response. Now, Stacy-Ann, excellent presentation once again. This is a time, like you said, you both mentioned, a time of great uncertainty, right? And one of the things that I've been wondering, and people who are in the circle have been wondering, is because of the uncertainty caused by COVID, when it hit in 2020, one of the immediate reactions was to preserve cash, right? Because you don't know what's going to happen. You don't know if you're going to need your cash to survive, to live off, because you don't know what's going to happen with your job and so on. So, but then now coming into 2021, 2022, we're looking at the higher interest rate environment. We're looking at inflation. So is now a time to preserve cash or to be more aggressive with our investments? Stacy-Ann?
So I would say now is a time to be a bit more aggressive with your investments. And let's think of it, right? So back to where we were before, where we had just started with the pandemic, the uncertainty was very new to us. We had never seen the world shut down before. It was only logical that you would just try to preserve as much cash as possible. But now that we have seen the road to recovery being paved, then we should be deploying more of that cash. And I can tell you, I can tell you that with the dip in the stock market, and this is just personally, right? Kalilah, I started to buy up Because what's my view? My view is that, okay, the longer term, I know there's solid companies, good governance, good management team, and they're going to come back. And so I just started to use it as my opportunity to average down, and I'll be waiting for that. So the message is, let's start putting that cash to use, greater use that can earn you more at this point in time. And just remember, good portfolio management always dictates that you should have some level of cash, right? Because it's not just for volatility and opportunities, but you always need to have a measure of liquidity for emergency purposes. So I would say outside of that emergency carve out that you're having, you need to start looking at ways now to deploy that, because I do think the worst is over for the pandemic and we're learning to live with it. And so we can deploy cash more.
Excellent point. And I like the point that you made in your presentation as well about the recovery from the 2008 recession. So 2008, we were down just about as much as we were down in 2020, almost 30%. And then by 2015, you saw where that rebound took us and the years beyond, #1 performing in the world and so on. Well, I see the questions are starting to come in. Let me ask Joanna Banks. Joanna has her hand raised. So Joanna, you can go ahead and unmute yourself and turn on your camera if you so choose and ask your question.
Turn on my camera. Thank you, Kalilah. Dr. King, I always love to hear you talk, and I have two questions for you. One, in your presentation, you had mentioned, I'm going to quote you, recessions free up resources. And I guess I'll put it another way, recessions can create opportunity. Or I guess we could also use the overused term, never waste a good crisis. Looking back at the last 2 years, do you think we've wasted any opportunities, whether it be as a private or public sector, as investors? And I saw some of your Twitter back and forth this morning, and I guess I would point to an example of perhaps we miss taking the time to upskill our labor force. How do you feel about that? And then my second question is, as you know, I'm also
Joanna, let him answer that one first, and then you can come to the second question after.
Yeah, beg you, because there are a lot of questions in the first question.
Right.
Now, when you talk about wasted opportunities, well, there are many opportunities, so you can't answer that with a single answer. One of the things that a recession does, and certainly one as deep and as broad as this, is it forces people to take advantage of opportunities. As we all know, we have many friends and relatives who have always been talking about, boy, there's this business I want to start, there's this thing I want to try, but most people are reluctant to take the risk of giving up their full-time jobs to do it. Well, when you get thrown out of work, then the hurdle disappears. And that is exactly why we see the record level of new company registrations in Jamaica and elsewhere. People are forced to take advantage of the opportunity of the crisis. So a lot of that has been happening. Another sort of positive development in a backwards way, the government tried its best to put emergency cash into people's hands. It was fortunate for us that it didn't do so by paying companies to keep people in their jobs, the furlough scheme like what they had in the UK, because what that does is it prevents a structural shift of resources, particularly labor, into these new opportunities. So in both of those senses, we didn't waste the crisis. Now, in terms of retraining, it's difficult for me to think about ways that could actually have been accomplished on the scale it needed to be within the crisis of a pandemic, where people had to be struggling for cash. The government certainly didn't have the resources. So the kind of retraining that would have been necessary and is necessary, I think, is difficult to do in a crisis.
Okay, thank you, Dr.
In this
King.
crisis.
Yep, and my second question is less about the crisis. As you know, I'm also a big West Indies cricket fan. Am I going to see Brandon play on Saturday?
Yes, he'll be playing on Saturday. As far as I mean, I don't have any inside information. Let me just make that clear.
Okay.
But I expect,
fantastic.
since he did well in Pakistan, that he will be playing on Saturday.
Fantastic. Congrats. Thank you.
All right, and just reminding you you can de-raise your hand, lower your hand now. And anyone else who wants to ask your question in person, use the raise hand feature. We have a couple of questions in the chat as well, so let me ask them here. The first one comes from Leo Ray Gordon. He says, good evening. We heard that unemployment is at an all-time low. However, economic output is still low. Without details on the labor market, without details on the labor market, I assume that many new jobs are low skill and part-time. What are your views on the implications for the economy over the medium to long term? I imagine that question is for Damien.
You know, I don't think it has serious implications. It's good to see that people have found something to do to earn an income, but that is all the unemployment rate tells you. We really shouldn't think about the unemployment rate as measuring the number of people who are in what we would consider proper, decent, formal sector jobs. Being employed only means that you have some kind of income, you know, from the work that you do. And a lot of that can be a hustle. And that's what you expect to happen when the formal employment opportunities disappear. So while it is good to know that unemployment is low in that sense, it's worse than it being high, it's worse than when it was at 12%. At the same time, we need to watch the headline GDP figure. That is the thing that tells us that real job opportunities are expanding.
Another question for Damien, although I do want Stacy-Ann to chime in here too. This question comes from Dania Palmer. She says, good day all. My question is for Dr. King. I just wanted to get a sense of what he thinks the trajectory for the policy rate looks like. Or is it a case where it really depends on how successful we will be at reining in inflation? So I want both of you to answer that question, but you can start, Damien.
Okay, well, I'm going to strongly defend why I don't know. Because this inflation targeting regime is new, and this is the first time it is being challenged by inflation going above the target range. So there are two things we don't know. We don't have a history of knowing how the central bank tends to respond to this kind of situation, whether they respond moderately or aggressively. We need to have a history of policy rates, you know, in an inflation targeting regime to know that. Second thing we don't know is the lag time and the coefficient of response, the strength of the response to the rising of inflation, to the increase in the policy rate, to know how much of an increase in the policy rate it will take to dampen down inflation. And again, because we don't have the history. So for both of those reasons, it's difficult to speculate. But I actually do imagine that somebody like Stacy-Ann would be in a better position to make that kind of speculation because she's in the financial markets.
Which is exactly why I want Stacy-Ann to answer the question, because I did hear you say in your presentation that expectation is for BOJ to continue raising the policy rate. I think I heard you said 3% and beyond. So what are your thoughts on that question, Stacy-Ann?
Kalilah, I just want to say thank you very much, Damien, for setting me up and passing the buck on to me. I appreciate it, right? But no, so he made a very important point. It's the transmission of the effect of the policy rate that is important, and we don't know what that is, right? And what we can say is that it could be aggressive, because if it is that you need it to take place, and it generally ranges, right? So I think it's probably like maybe 3 to 4 months that it generally takes to actually see these things come out. And so depending on the comfort level of the Bank of Jamaica in terms of how that transmission is taking place, that's really what's going to guide it. So having said that, that is setting the tone for the reason why it could be more. Because if they need to rein that in at a faster pace, and now, of course, depending on what else happens in the international global sphere, especially as it relates to commodity prices, it could be possible that we could see a significant increase. So remember, the range we're saying in the next 6 months could be between 25 basis points to another 50 basis points. But of course, because we don't have a crystal ball, there are many upside and downside risks to that, right? So we just have to watch and see how that plays out.
Right, and as Damien mentioned, we don't have a history of knowing how the BOJ typically responds to these things, especially now with their newfound independence. You mentioned a keyword to commodities. I don't think you mentioned that in your presentation. Does that falls under alternative investments, Stacy-Ann?
No, so I would have mentioned, well, it was on one of our slides, and it was a slide that speaks about inflation, what's driving it. Because as inflation increases, one of the inputs for that is energy. And as you would have seen, I mean, even in just a couple of days, the energy prices have gone up. So energy particularly, and then also too, you have commodities from the food standpoint that would feed into that. And so that does impact inflation. And so we have to watch that.
Oh, well, my question about commodities wasn't so much about how it impacts inflation, but what should we be doing with that regarding our portfolios? Should we be looking to commodities investments?
Okay, so for commodities investment, it's really about playing the volatility and pricing in that outlook, and then taking a position. So we go back to what drives your investment decision. If you're going to take a position in commodities, then you have to have an outlook. What drives that outlook? The demand, the supply challenges that you're having, how does that impact commodities? So whether that be oil, whether that be wheat, there are different types of commodities that you can play. And you do that typically on the international market, but then your investment philosophy, this is where it comes in. What are you focused on? Is it the short term, long term? And you have to just develop that to be able to see if commodities is the right thing for you. And that's pretty much on the higher risk spectrum, right? So you have to have a pretty high risk tolerance to be able to play in that commodity space.
Thank you very much. So reminding our participants that you can use the raise hand feature to ask a question in person, or you can type your question or comment in the chat. We only have a few minutes remaining. So if you have something burning, speak now or forever hold your peace. So we have a question in the chat from Monique French, and she asks, how does crime play into your outlook, Dr. King? If the impact of the pandemic is underinvestment in infrastructure, human capital, infrastructure/human capital, how will that constrain recovery growth?
You know, there's really not much we can say about the impact of crime, except that to say that crime is a level determinant. I mean, we're concerned about what has happened over the last few weeks and months, but we have had high rates of violence for a long time. And so the continuation of high rates of violence is not going to have a worsening impact on the economy. If by chance the level of violence changes in a significant way, then we're going to see an impact.
Well, if there are no other questions, I'm going to ask the last one, and this one is for Stacy-Ann, because you did discuss real estate during your presentation and discussed that coming under the portfolio of alternative investments and some of the things that NCB Stratus is looking at. You mentioned something that I've been hearing a lot lately, that the outlook for you is commercial and industrial real estate. These are the areas that you think will be, I guess, hot, for want of a better word, in the coming months and years. But when you look around Kingston, you did mention residential. When you look around Kingston and look, not just Kingston, all over, you continue to see these high-rise apartments going up, and there seems to be significantly more investment there than there is in commercial and industrial. Why is that, you think?
Well, Kalilah, nothing gets done unless there's a market for it, right? So there has to be demand for it. Why you see everywhere you go in Kingston, there's an apartment complex going up. And what we want to remember is that the pool of investor base is global, right? So when we see some of these complex type constructions going on, what you're thinking of is that you're thinking of the diaspora market. There are persons internationally who are investing in these properties, and then you have the local pool. So there is a demand and a sector of the market for which apartments, especially in the metropolitan area. It's heavy and it's for different reasons. You have motivated by business, motivated by another vacation home, so to put it, in the heart of the city. But in terms of just for business purposes too, whether that be for Airbnb, short-term rentals. I mean, as you think of persons becoming more opportunistic and entrepreneur type led, then what you'll find is that they're looking to these real estate investment, especially in the metropolitan area, to be able to do that and to pay that. So there's a space for that. And you're right, you probably see that a little bit more. And as the demand for the manufacturing type space and the warehousing type space continues to grow, you are going to see some proliferation in the level of supply that goes out to meet that demand, because there really is a strong demand and it's growing.
And I'd like to urge you to use whatever influence you may have in that sector to make sure that when they're doing these commercial developments, that there is adequate parking.
Okay.
We need the parking.
I'll ensure that Stratus remembers that. We need lots of parking.
Please, please do. All right, I don't see any other questions coming in the chat, but this has been a very, very useful session this evening, and it was my pleasure hosting you. Before we wrap up, I would like to ask our presenter, not our presenters, our viewers this evening, to take the second poll. So rate this event. Let me see if it's popping up.
Kalilah, sorry, before
Yes.
you go to the second poll, we have another question here that was submitted privately. Would you like me to read it?
Sure, I don't see it, so go ahead.
It says, given the low vaccination numbers locally and the high positivity rate, do you see this as a threat to the recovery expected in 2022? I think it was Stacy who made the point about further lockdown being unlikely. Is there a certain point in which the cost of remaining open becomes too great? And do you foresee the high inflation in the US having any sort of impact locally?
Great question. Does Stacy-Ann, you want to take that?
So there are a lot of different parts to that question. So at what point do you balance, and I'm going to take a phrase from the Prime Minister, lives with livelihood? I heard that coming out. What was the other part of the question, please? Could you repeat?
The other part is, do you foresee the high inflation in the US having any sort of impact locally?
Okay, so let's talk about the inflation first in the US. Yes, because US is our major trading partner, right? And if you think about, and I'm just going to use something as simple as clothes, right? A lot of us get things from the US in terms of clothing items. I mean, that's just a simple item, but to just show you the level of practicality in our economy, is that yes, it will affect us because they are also facing the same level of supply chain issues. And if anybody here is a shopper on Amazon, you'll see that. You try to buy stuff and you realize that look at the prices of where things are now as opposed to where they were before. And you'll see that there's definitely a change in price. So definitely it will impact us here. And that's a part of the imported inflation, right? Because it's coming from another source and they're being affected by the same supply chain issues. Now, with regards to, is there a price? Of course, life is very precious, right? And again, just taking the phrase from the Prime Minister, balancing lives with livelihood. You know, there are lots of persons who are not in corporate Jamaica and they earn a living from the economy staying open. And that's the informal sector. Now, the informal sector is very big. And a part of balancing the lives, because it's so important, is that you have to keep the economy open. So having said that, I would say that the solution has to be in how one and the mass of the population protects itself. So protects itself in the form of adhering to the different protocols, protect itself in the form of taking the vaccination. And then, as I would have spoken to in the presentation, there are new medications that are coming on the scene. They're trying to develop a tablet for COVID. So it has to be in protection in terms of immunity. And then the next level of protection has to be to protect the vulnerable in terms of earning an income and just keeping the economy open for that very reason.
Thank you very much for that response. Yeah, that definitely is a huge issue. And I think they have actually developed the tablet already, at least one. I don't remember which pharmaceutical company, but yes, there is a tablet available for the treatment of COVID-19, which I think is the next frontier of dealing with this pandemic, being able to adequately treat the symptoms. So take our second poll, please, participants, all of you who are still with us. How would you rate this event on a scale of 1 to 5? 5 being informative and engaging, and 1 being, it needs improvement. So 5 is your best score, 1 is your worst score. I'm going to go ahead and I'm not going to tell you my answer, although you can probably guess what it is, and click submit. So take that poll for us, please, and because feedback is very, very important. So just before we go, I have a quick few thank yous to say. I want to thank you, all the participants, for joining us this evening. I saw 60 something of you, 66 I think was the highest number I saw, and that's a great turnout. So thank you so much for joining, for giving us your time, for participating, for asking questions, for being engaged, taking the notes, and so on. Thank you, of course, to our distinguished presenters this evening, Dr. Damien King and Stacy-Ann Tait. Thank you to the CFA board for your continued support. This event wouldn't be possible without you. And special thank you to Karen Lewis Matthews, our executive support, who continues to go above and beyond to help with execution. And once again, a special thank you to you, our attendees, especially the members of the CFA and the candidates, those of you who are potential members, for joining. Remember, you can contact them at, I hope you wrote down the email address because I didn't, but you know how to reach them, to reach the CFA. Just reach out to the people who organize this event, where you signed up for this event, and you can find out how you can become a member. Thank you once again. My name is Kalilah Reynolds. It was my pleasure hosting you this evening. Until next time, have a great evening.